This is Mike Swanson of Wall Street Window. I got a special interview for you in just a few moments. I'm going to be speaking with Jordan Roy-Byrne, who runs the website, thedailygold.com. We've seen the stock market drop all year, but we had a rally, and then Friday the rally ended. The Dow fell 1,000 points. We've been going lower ever since. All that talk of the Fed pivot was a mirage. It wasn't real. But gold is now pulling back too. How can we understand this? When is it going to end? That's what I'm going to speak about with Jordan right now. Hello. Well, I'm here today with Jordan Roy-Byrne, who runs the website, thedailygold.com. How you doing today, Jordan?
Hey, Mike, I'm well. Thanks for having me on.
Well, you've written a really interesting article about the historical comparisons for gold and silver. And I was telling you before we got on the air here that I got to admit I was really tricked or fooled by what gold has done so far this year because I thought as the first quarter unfolded, that we were seeing something like what happened in 1973 play out. You know, inflation exploded that year, and there was a big bear market in the stock market, but gold went up. Silver went up too. And the bear market was a 50% decline in the stock market, but gold, went up through the whole thing. And unfortunately, the way it looks is, who know, things can change, but the stock market is plotting out like analog to that 73 chart, but gold certainly isn't, because gold has fallen to the stock market over the past couple days, but it was trading even weaker than the market on this past rally. So what do you think is going on, and what can we compare this to?
Yeah, well, I have to admit, Mike, that I thought the same. I mean, March, April, that time frame, I thought, this is like as you said, 73, 74, where, we had inflation, we had stagflation, and, precious metals looked like they were primed to make a really big move as the economy suffered and went into recession. I mean, I obviously was completely wrong about that. But, I mean, here and now, first for the stock market, I'll say, and I think in my last interview with you, we discussed this. I mean, in secular bear markets, there's been 6 cyclical bears within 3 secular bears. So you have 2 really bad bear markets within these larger secular bears. And that's really the question right now is the S&P 500 U.S. equities, are they in the first inning or so of what's going to be a secular bear market? Or are they just correcting and following something like what happened in 1962 or 1966, for example, where the market corrected over 20%, but it was able to rally back and it trended higher. So I think that if you're bullish, that's one of the bullish comparisons. But as far as the bearish comparisons, we talked about this. The median and the average of those 6 bad bears when they tested the 200-day moving average. So they had a decline, and then they rallied back up to the 200-day. It happened in all of those 6 bear markets, a median and an average around 7.2 to 7.5 months. And we literally, the S&P, I think it was on August 15th, so almost exactly 7.5 months in, it tested the 200-day moving average. It's obviously sold off quite a bit since then. So I think the coming months are going to be really interesting with respect to, can we see the stock market, retest the low? Maybe it puts in a significant bottom and the economy doesn't go into recession, or there's only a mild recession, something like that. Or we get into, we're heading into a full-blown real recession. And in that scenario, the stock market would sell off, and it would decline to lower lows. It would go below 3,600. You'd have a real bear market. I mean, the 1968 scenario, I think the bear market was 37% at that point in time. So it was kind of, I think, the most mild out of these 6 worst declines. And if you just look at precious metals against the stock market and those ratios, it's most similar to the mid to late 1960s. And delving into that a bit deeper, Mike, if you looked at what happened after 1968 and that the 68 to 70 bear market and that recession there, it's very interesting because obviously the gold price was fixed. Gold stocks did well before that, but gold stocks and silver, I mean, gold stocks peaked. The rate of inflation peaked, I think, in 1970, around the middle of 1970. Gold stocks peaked about 2 years before the peak in inflation, and silver also peaked, I want to say 1.5 years before, plus a month or two before the rate of inflation peaked. Now, today, precious metals as a whole essentially peaked 2 years ago, 2 years and 1 month ago, August of 2020. And the rate of inflation statistically probably peaked a couple months ago. So that's one really strong similarity. The other really strong similarity, there's actually three. The second one I would say is the rate of inflation broke out in early 1968. And so at that point, it broke out to a 16-year high. And then the next year, 69, it was a 17-year high. So that was basically the biggest breakout, the most significant move in inflation since the 1940s. And what makes it really interesting is the Fed they weren't fighting inflation in the 1940s. They basically had to let it run to devalue all the debt from the war. So the Fed had never really embarked on really tight, monetary policy, almost in history, you could say. So in the late 60s, when the Fed started hiking rates, that was really the start of it. So that's another strong similarity to today because they haven't had to deal with inflation for 40 years, basically, more than in a generation. So that's another point of significance. And then the third thing I would say is if you just look at precious metals ratios against the stock market, whether it's gold against the stock market, silver against the stock market, less so gold stocks against the stock market because they did have some strength in the mid to late 60s. But if you look at these ratios today, and then you compare them to where they were in 1968, 69, 70, they look very similar to today. So today, people, precious metals investors and gold bugs can say, what the heck is going on? We had this huge move in inflation. Yeah, the Fed's fighting it a little bit, but if we look at these ratios, like we're down in the dumps compared to the stock market. We're nearing multi-decade lows on these ratios. Well, if you look at 1969, 1970, it's almost exactly the same. Where at that point in time, you could say, look at where precious metals are relative to the stock market. They're trading at multi-decade lows. I mean, I think even silver, the silver to S&P ratio in 1969, 1970, it was lower than it was in 1929 or 1930. So what you're seeing today with the frustration with precious metals, almost you could probably, people had similar frustrations 1969, 1970, and that was after we had this huge move in inflation. So that's another strong similarity. And so back then the Fed, they had more room to hike rates because there wasn't a debt problem. So, they hiked rates. I think they hiked rates from like 3% to 9%, if I recall correctly. I'm not sure. I'd have to double check that. So they hiked rates. They did get inflation to come down somewhat, but, eventually when the economy turned up again, inflation became a real problem. And, with respect to precious metals, gold, the price of gold was fixed, but gold stocks bottomed roughly a year after, 12 months after the bear market in the S&P began. So that would put, I mean, if we're applying that analog to today, that would say they would bottom in December. And then a month after that, that's when the Fed started cutting rates. I mean, given where we are here and now with precious metals, I mean, they're breaking down again. I think you could see a bottom in the next couple months before December because I think they're going to get really oversold, and I think that the Fed is going to be forced to stop at some point in the next couple months. And I think that is going to signal the bottom in precious metals. So I know that was a mouthful, but that's a history lesson in how it applies to today.
Well, I'm looking at, at your article that has the charts on it as we're speaking. And one thing that happened in 69 and 70 is gold stocks bottomed out. It looks like it was December, but the stock market didn't put a bottom to May or June. So gold stocks bottomed before the stock market. And the same thing happened in 2008, 2009. Gold stocks bottomed in October 2008. The stock market didn't bottom until March of the next year. So that's what I'm kind of looking for to figure out when it's time to really get in big on the gold stocks again, is when they start to, hold up or start to go up even when the stock market goes down. And on your chart, they were this BGMI is the mining stocks. It was going up, when the stock market had its final leg down, it was going up. And interesting enough, the mining stocks, they peaked out ahead of silver, and they also bottomed before silver did. So those sort of positive divergences that we've seen play out several times, since we've been looking at these things in real time, they played out back then too.
Yeah, I mean, silver was kind of funky. It took a couple, a year or two more to bottom. So I don't know what to make of that. I mean, silver had a 50% bear market. Gold stocks had a 60% bear market during that point in time. So you can compare that to today. But I think, looking at the stock, and I'll also throw in, Mike, because I know you're familiar with, 2000 to 2002. That was another example of precious metals bottoming before the stock market. I mean, gold bottomed, I think, around March of 2001, October 2002 is when the market bottomed. The gold stocks, as you know, they bottomed November 2000, so even ahead of gold. So if you're looking at these various potentially similar bear markets, yeah, the gold stocks bottomed ahead of the market in every case. And I think we'll see that happen again. And I think because the key is if the stock market rolls over again and makes a lower low, obviously that's going to reflect that we're probably going into recession. The rate of inflation will come down quite a bit, and then the Fed will obviously stop hiking rates, and they'll eventually have to cut rates. And so that shift in policy is immediately bullish for precious metals. And I mean, eventually, yes, it will help the stock market. But I mean, they usually cut rates. The Fed cuts rates when the economy's in a recession. It takes a little bit of time for the recession to run its course and the stock market to bottom out. But I mean, the real big thing for me, Mike, that I'm watching is the S&P making a lower low and losing that 40-month moving average. Because if you look at secular, I don't know if I mentioned this in the article. I mean, I probably have with you before, but if you look at the secular bull markets in stocks, the 40-month moving average, which on a weekly chart is the 167-week moving average, if you look at those moving averages, they pretty much provide support during a secular bull. I mean, it's not entirely foolproof because we had the COVID crash where the market crashed below the moving average. But if you look at secular bulls over the last 100 years, quite a few times during a secular bull, when the market has like a 20%, 25%, 17%, 15% correction, it will come down and bottom right at that moving average. And so what happened in 1969 and 2001 and after 1929, that was the first time where the market really significantly fell below that moving average. And so that was a strong signal that, okay, we're now in a new regime. We're in a secular bear market. And so I think that moving average is, I want to say it's coming up close to 3,700 now. So again, this is so important. If we see the stock market make a lower low, it loses that moving average. It doesn't matter if it comes down to 3,100 or 3,000 or 2,800 or 3,200. I mean, as long as it loses that moving average and it has a 35% or 33% bear market, that's going to be significant enough to signal that, we're in a new regime where this is a new secular bear market for the S&P. And that is so important for precious metals because that is what has been lacking over the last 5 or 6 years, where, yes, the fundamentals have been pretty good for precious metals, but the stock market has still been going up. It's still been in a secular bull. If you look at this gold, silver, and the gold stocks, their absolute best performance was during the periods when the S&P was in a secular bear. You can look at 68 to 82, 2000 to 2011. Those are the periods when, and also 1929 to 1942, those were the periods when precious metals had their biggest gains across the board. So that's why the stock market and this particular cycle is so important. If it makes a lower low, loses that moving average, that's going to signal that precious metals are going to have huge gains over the next decade. The other scenario, just to cover it, if the S&P, maybe it declines more, but it makes a double bottom. You get something like 1962, and you only have a mild bear market, or it's like a very mild recession. In that scenario, you're not going to go into a secular bull for precious metals just yet. I mean, in that kind of soft landing scenario, Mike, if you look at all the soft landings, they were all triggered by the Fed pivoting and having to cut rates. So in that positive scenario for the stock market, like you would see a move in precious metals when they cut rates and the economy recovers. You'd see a move in precious metals, but they would not have this like multi-year move. They would just move for like 6 or 9 months and then they'd fall back again.
Well, I don't think they're going to pivot anytime soon. I mean, I think inflation is a bigger problem for the country than, someone blowing up their Robinhood account because the stock market declines.
I mean, that is true, but I don't know. I mean, I don't think they're going to be able to hike rates to 4%. If you look at the terminal rate, if you're just looking at Fed funds futures, the terminal rate is around 3.7, 3.8%. And if you look at, the odds of the Fed hiking 75 are higher than them hiking 50. So if they hike 75, they're already at 3.25% at the end of this September. So after that, I don't see the Fed hiking that much more. I mean, most of their hiking is done. There's no way they're going to go above 4%. They're going to cause serious damage. And, we have to watch the bond market as a trigger. If the 10-year yield starts dropping again, that's going to be a signal. I mean, that's going to happen ahead of the Fed shifting policy. And we also have to watch the dollar. I mean, if the dollar is trading around, 109, 110, something like that. I mean, if that hits 120 in the next couple of months, that's going to bring a lot of pain to other parts of the world, and that'll come back and hurt U.S. companies. So there's all these things that are in motion that can force the Fed to pivot and eventually cut rates. I mean, I'm not saying it's going to happen in a month or two, but I mean, Mike, you've been watching markets for decades. You know that these shifts in Fed policy, they can happen very quickly. I mean, if something breaks in the next month or two, then they're done hiking. But if the stock market is trading at this level and it just hangs around here for months and months, then yeah, the Fed's still they're going to be able to hike rates up to 4% in that scenario, and precious metals they're going to struggle if that's what happens. So these are the scenarios that we all have to think about. But I'm leaning towards the stock market eventually is going to break lower. We're going to have a real recession, and precious metals will rebound and begin a real new bull market.
Oh yeah, I think that's where it's all headed for sure. Myself, I mean, it's just, and I'm looking at your chart from 1971, as you mentioned earlier. We were talking that gold S&P ratio just being flatlined right here. That's what it's going to take to make it go up to the upside. Then it'll be an unbelievable run, if that happens.
Yeah, I mean, it absolutely will be, because if you look at these ratio charts and you look at gold priced against the monetary base, gold against the S&P, gold against something else I'm forgetting. But if you look at these, ratios, and you look at 100-year charts, they show that gold is trading around its very close to like its 2000 bottom in 1970 level in real terms. So, when gold has a real bull market, when the S&P goes into a secular bear, gold isn't just going to go to, 3,000 or 4,000. It's going to go to 10,000. It's going to go to 15,000. Now, I'm not saying that's going to happen, in 1 or 2 years, but, that is, to me, I see that happening over the next decade. That's what happens when you get into a real bull market.
Well, the ratio, I'm looking at your chart, gold versus S&P 500. Basically, that ratio needs to get above or go above the high it made in 2020. That's what, to break out.
Right. But even if, what was the high yeah, that's true. Yeah. And that has not made a new low. So if we're zooming in on you can't see it, but if you're looking at a 1 year chart of that ratio, that has not made a new low. So that's a key thing to watch. If we see the S&P and gold, they both continue to trend lower here for a couple months, continue to watch that ratio and see if gold, maintains that low against the S&P.
Well, one thing too, one last thing I want to add about that is in 2008 the mining stocks crashed, but they bottomed in October, I believe, or November, and the market bottomed in the next year. But gold pulled back, but it didn't crash. In 2020, the stock market basically crashed. The S&P fell over 30%, but gold didn't pull back half that. And I would not be surprised. I know the mining stocks are weak today. They're trading at a new low for the year. Gold's down too, but look, I think the market's going to break that 40-week moving average you're speaking of. But I would not be surprised if the S&P 500, we don't see an overall 30% or even more decline from the January high. A big bear market here, but I don't think gold. It could go down to 1,700. It could go down to 1,650. I don't know, or even 1,600. But even if it did all those things, I think the stock market would be falling much more on a percentage basis, which will help that ratio maintain its, not be going down, but holding them, still continuing to base out.
Yeah, absolutely. No, that's a great point. If you look at 2008, the COVID crash, that's an excellent point. And even so far, the stock market corrected 25% off of its high in December. If you look at gold, if we look at the secondary peak, gold, I don't have a chart in front of me, but so the secondary peak in March or April, where was that? Around 2000?
Yeah, 2000.
Something like that. So yeah, and gold's in the low 1700. So gold's down, roughly 15% or 14% when the stock market, the gold's biggest decline down to 1675. So it was from, 2000 or wherever. So it was 15, 16, 17%. The stock market went down 24%. So that's just one example that you're talking about. But I do agree with you. If the stock market breaks lower, gold will strongly outperform. If that happens, because the stock market breaking lower, that's going to lead to the Fed having to shift policy. And so that's when gold really diverges from the stock market. But yeah, it's certainly possible. The stock market could declines 20 or 25% from here, and maybe gold only goes down 10% in that kind of scenario.
Right. Well, I think this about sums up your article, what we've been talking about here. I'm going to link to it so people can read it themselves. But what else do you provide at thedailygold.com?
Just quite a bit of free content. I write an article every week. All the interviews that I do, the people that I interview, those are all published at thedailygold.com. And I have a premium service where we're looking for junior miners that can really benefit from the coming bull market. It's obviously been a tough year, but the prices that a lot of these quality companies are trading at, they have real potential. If we get into a real bull market, I mean, a lot of these stocks are going to be 10 baggers over the next couple of years.
Well, that's where the money's made. It's when getting in when this is all done with, and for real, I mean, it's going to be that's going to be an exciting time. But the only way you can take advantage of that is to be ready. Yeah, it's not. They're not going to tell you it's here on your Robinhood app.
That's right.
Well, thanks for talking to me and my listeners. We'll hopefully do an interview soon.
Sounds good. Thanks so much for having me, Mike.